Hey everyone, it's Bill Warrell, your Bradenton, Sarasota Realtor, and this is the first of a three-part series in which we're going to talk more about mortgages in depth. We're going to be talking to Kyle Jacobs with Fairway Funding, and he's got some really good information for you. So let's get into it. Let's go. Hey Kyle, how are you doing?
Great, Bill. How are you today?
Good, thanks. Hey, for everyone watching this video, why don't you introduce yourself and tell us a little bit about what you do?
Okay, my name's Kyle Jacobs. I've been a mortgage lender doing all residential mortgage lending for 32 years. My background includes being a broker. When I first started, I was a mortgage broker. I spent years working as an underwriter, which helps me significantly in my career, understanding how to get folks loans approved, knowing the hurdles that'll come, thinking a couple steps ahead. I was the operations manager for the company I work for now, Fairway Funding Group, for 5 years. And in 2013, I decided to give up my management title and just originate loans, which is what I've been doing. But this year marks 32 years in the business. I started in 1989.
Wow. All right. Well, this isn't your first go around then.
It is not.
So let's start with the basic. What is a mortgage?
Well, the mortgage itself is actually the document that puts your house that you're purchasing up as collateral. The money you're borrowing, just like any other loan, if you were to buy a car, you're going to sign a promissory note. With a mortgage, you sign a promissory note for the money you're borrowing. The mortgage is actually the document that says, hey, if anything ever went south on this and the bank had to foreclose, the mortgage is what says the house is the collateral. But we don't think about it that way. In the industry or the average consumer, they just think of the mortgage is, I'm applying to borrow money, for the house that I'm going to buy.
Right. Okay. So when I make my mortgage payment every month, what would be included in that?
The basic part, the first part, of course, is going to be your principal and interest.
Okay.
That's a portion of your mortgage. If you have a fixed rate mortgage, which almost all loans today are fixed rate mortgages, there are some adjustables. Some of the things that got us into challenges back during the housing crisis when the subprime mortgage industry was so prevalent, there was a lot of adjustable rates, but most loans are fixed rate today. So that portion of the loan is never going to change, your principal and interest. Then on top of that, you're going to have your taxes. Easy calculation. Look at what the tax bill is, divide it by 12. That is going to be added to your payment. 1/12 of your homeowner's insurance premium. And then for many folks, there's also going to be mortgage insurance. And mortgage insurance is going to be part of your mortgage payment if you're purchasing with less than 20% down.
Okay.
Now, there are certain loan programs like FHA financing, which we'll probably talk about at another time, that are going to have mortgage insurance even if you put less than 20% down. So there'd only be rare cases where you would use that type of loan if you had a large down payment.
Okay.
And then not part of the mortgage payment, but part of what I would consider part of the housing payment as a mortgage lender is any condo or homeowners association fees. So you won't pay those condo or homeowners association fees as part of your mortgage, but when I'm running a calculation for someone on how much house they can afford, that payment will be part of the equation.
Okay. That's a good segue, because the next question, as you talk about how much house you can afford, the term debt to income ratio, and we've all heard lenders use that term before. Can you explain that a little bit and how that might affect me getting a mortgage and what my terms might be?
Absolutely. There are, in the industry, you don't see it so much on the back end as the consumer, but there's basically two different debt to income or debt ratios that we look at as lenders. The first is the housing ratio itself. So what the housing ratio is what is my total housing payment, principal, interest, taxes, insurance, HOA fees if I have any, mortgage insurance if I have any. If I'm in a flood zone, flood insurance would be part of that. So I have my total housing payment. And then we're going to look at your gross income, not your net income, not your take-home pay, but what's your gross monthly income before taxes. The ratio of your housing expense to your gross income is your housing ratio. So if you make $4,000 a month and your total housing expense all included is $1,000, your housing expense ratio is 25% of your gross income. Now, what's looked at more importantly is your total expense ratio. So on top of the housing ratio, we're going to add the monthly payments that are going to be reflected on your credit report. That would be a simple way of looking at it. Now, if for some reason you have a car payment that's not in your credit report, it's still part of your ratio, may be found out. So what I would look at as a lender is your credit report. You're going to have car payments, minimum credit card payments, potentially student loan debt, and all of those monthly payments added to your housing payment is your debt to income ratio. So using real round numbers, if I have $1,000 housing payment, I have $1,000 in credit cards, car loans, student loan monthly payments, and my total expenses every month is $2,000, my income's $4,000, my debt to income ratio is 50% of my gross income. So we would consider that a 50% debt ratio. What's not included in that are utilities, car insurance, your home insurance is, but for the most part, anything that's going to be included is going to be found on your credit report.
Okay. And do you know offhand what that percentage might be, or what an ideal percentage would be for a mortgage?
Well, there's a difference between the ideal and what you can qualify for.
Right.
Because a lot of folks buy homes that they qualify for, but it may be still expensive for them. So for the most part, conventional mortgage financing looks at a maximum of 45% debt to income ratio. So
Okay.
the total cost of my house, the total of all my debt that's on my credit report, that can't exceed 45% of my gross income that I can use to qualify. With that being said, there are some exceptions that will get as high as 49%, excellent credit, larger down payments.
Okay.
And you have the government loan programs, FHA financing, very commonly used for folks with low down payments, often used by first-time home buyers. That actually goes as high as 55 to 56%.
Okay.
Very high, higher than I would recommend. But there are certain situations where maybe you have one spouse that we're not using on the loan. So I know there's really more household income than what we're using to qualify. Maybe one spouse has real credit challenges, so we're choosing not to use them. So, but I can go as high as 56%. And then there's VA financing, and VA financing goes even higher than that to sometimes some crazy debt to income ratios. I've approved loans as high as 75% debt to income ratio. Most lenders won't do it, but the VA will guarantee a loan in certain circumstances with income. And the only time that ever makes sense is, again, maybe there's a spouse, maybe folks have a lot of money in their retirement plan that they're not drawing on yet.
Okay.
So that's it. But a good rule of thumb is 45% total. But in my opinion, folks that are at that level are still, they're spending a lot of money. I prefer to see less consumer debt so they can be comfortable with the payments.
Okay, good information. One of the other questions I get a lot is, how much of a down payment do I need to put down? Can you talk a little bit about that?
Sure, absolutely. The standard minimum down payments are either 3 or 3.5%. The most common loan used for folks with lower down payment and lower credit scores, higher debt to income ratios is the VA loan, FHA loan, I'm sorry.
Okay.
And there's actually a misconception by a lot of consumers, and in some cases, even real estate professionals, that the FHA loan is a first-time home buyer loan. It is not. You could have owned 10 homes. Just the caveat is, in most cases, there's always exceptions, but for the most part, you can only have one FHA loan. So if you had an FHA loan, you're buying a new house, you decided to keep your current house as a rental property, you can't get a second FHA loan. But the FHA loan requires 3.5% of the purchase price of the house as the minimum down payment.
Okay.
Conventional financing allows for 3% down. In that case, if you're putting 3% down with conventional financing, you do have to be a first-time home buyer. Now, the definition of first-time home buyer in conventional mortgage underwriting is not having owned a residential home in the last 3 years. So if you sold your last home, maybe you had challenges during the housing crisis, sold your home, had a short sale, and you haven't owned a home for the past 36 months, you are considered a first-time home buyer for the sake of the lower down payment loan or any other loan programs that may be available to first-time home buyers.
Okay. And let me ask too, because I run across, because we're such a touristy area here in the Manatee area, I get a lot of people interested in purchasing investment properties. Mm-hmm. Or they live up north and they want to purchase a property down here as a second home. Does that affect their down payment at all?
It does. Absolutely, it does.
Okay.
With a second home, you're talking almost exclusively about conventional financing, because an FHA mortgage, a VA mortgage, and a USDA mortgage are all for primary residence. So if you buy a home as a vacation home, second home. Now, the term in the industry, we use second home, but second home doesn't mean it's the second home that you own. It means that it's going to be used for personal vacation purposes. Okay. So if you live in Sarasota, you're not going to vacation in Lakewood Ranch. But if you're buying a property in Lakewood Ranch, it may be an investment property. So the minimum down with a second vacation home is 10%. Interest rates up until only a few months ago were identical with a second home versus a primary residence. Okay. Well, a few months ago, Fannie Mae and Freddie Mac made some small adjustments, so the interest rate could be 0.1% higher on a second home versus a primary residence. Now, investment properties are a whole different animal. With an investment property, you can purchase with as little as 15% down, but the interest rates are significantly higher and there's mortgage insurance. So for the most part, I tell folks that an investment property, you want to be looking at 25 to 20% down, and there is a relatively big difference in interest rate between putting 25 versus 20% down with an investment property that you wouldn't have that big of a difference with a primary residence. So for instance, right now, the difference between putting 20 versus 25% down on an investment property is about 0.5% in the interest rate.
Okay. Okay. Speaking of interest rate, what kind of factors would affect my interest rate?
With conventional financing, it's all almost all, I should say, credit score driven. Okay. So credit scores are very important with conventional financing to get the best interest rate. So for instance, when you see companies advertising interest rates, typically they're advertising with at least a 740 credit score and typically with a 30-day interest rate lock. That's another thing that can impact the interest rate is the interest rate lock period. But in the conventional finance world, 740 is typically the threshold. So if you have a 740 score, you're going to get the best interest rate that's available. If you have an 800 score, in most cases, there's not going to be any difference. However, in conventional financing, once you go below 20%, once you go below 740 credit score, and every 20 points thereafter, there's going to be an adjustment in the interest rate. So there's a tier of 740 plus, then there's 700 to 719, and I'm sorry, 720 to 739, 700 to 719, and then every 20 points down to the minimum credit score required for conventional financing is 620. But if you have a 620 credit score, your interest rate is going to be significantly higher if you qualify with conventional financing.
Okay.
So credit score is very important. One of the things I work with my clients is I will run their credit, and I have a pretty sophisticated credit score program, so I can look and see how will certain changes to their credit profile impact their interest rate or their credit score, and thus the interest rate. So a lot of what I do with my clients is helping them to get into the best position to purchase. For instance, there'll be cases where I'll have someone with a 700 credit score. They would be 2 tiers below the best interest rate with a conventional loan. And it could be as simple as paying off $500 or $600 in credit card debt to get their score to 740.
Okay.
Prior to about 8 years ago, for me, it was an educated guessing game. But now with the sophistication of my credit scoring program, I can see if I pay down $200 on this credit card to get it below a certain threshold and $300 on another, what impact is that going to have? So it's become a big part of what I do. Debt to income ratio can have an impact because once you get above 45%, which there are cases, that can impact the mortgage insurance, but not the interest rate.
Okay.
Now, if we look at government financing, for instance, FHA financing, the difference in the credit scores will not have as much of a difference in the interest rate. So for instance, with a conventional loan, if I have a 640 score versus a 740 score, it could be 0.75% different in interest rate. With an FHA loan, the difference between a 640 score and a 740 score may only be 1/8%. So for the person with lower credit scores, oftentimes the government loans, FHA, VA, USDA are a great option.
Okay, that's good to know. Hey, if you're watching this video, and some of this information went over your head, I know some of it did for me. If you get nothing out of it, get this, that you don't get this kind of advice when you're just going to a website and applying for a mortgage. So if you're looking for expertise in this field, as you can see, as Kyle's talking and answering these questions, he's displaying an expertise that I found to be second to none. So you would be wise. I'm going to post his information at the end of this video here. If you have any mortgage questions, you can always go to his website. You can always give him a call, send him an email. He's always good for answering those questions. So Kyle, thanks for taking your time with this first session of ours, and everybody stay tuned for session number 2. Thanks.
Thank you, Bill.